welcome to the closing bell on the 2nd of July. What a month June was. Complete mayhem unfolded. If you've been watching these videos, of course, you were expecting it, and hopefully you managed to dodge a few bullets there over the last few months, and you're not freaking out like the whole world is. We're in a state where things are selling off pretty hard, but it gets trickier the lower it goes because volatility picks up. You're always wary of the big short squeeze that can come out and happen at any moment. The way I'd look at it at the moment, this market, is it's like a rubber band. Imagine you're stretching a rubber band as far as it can go. Now that rubber band is either going to snap and everything's going to collapse, or that rubber band is going to snap back, isn't it? So that rubber band at the moment is stretched pretty far to the downside. And we're at that point where that rubber band either snaps and the whole market is just going to go into free fall for another big leg lower, or we're just going to see that mean reversion happen, which will shake all of the current shorts out, get people bullish, and get the market ready for possibly another big leg down. But we're at the stage where things are softening off so quickly. All of the recession articles are coming out of the woodwork. Everyone's looking at the weekly employment figures in the US, unemployment numbers, people applying for new unemployment benefits. Everyone's watching those numbers like a hawk. Really, inflation, therefore, is being seen as something that may top out quickly, that the Fed's not going to need to raise rates as far as people thought. But this is all conjecture. But because the market has sold off so far, it's just starting to get that rumblings of, the bonds are starting to get bought with the US 10 years above 3%. People starting to think, well, if I can get a definite 3% from here with the market looking like it's going to collapse, maybe I'm happy with that. So the bonds rallying, taking a bit of pressure off. Maybe the stocks are going to try to find some sort of short-term bottom. But is it the bottom of the whole move? I don't think it is. And I'll just take you through a bunch of charts. But, commodities are starting to roll over as well. So you're seeing iron ore, copper, which is the big one, Dr. Copper, starting to get belted. So really, there's nowhere to hide. And I, for one, am not trading too much at the moment. I'm really being very careful. But now that tax loss selling is done, there may be a few opportunities out there for a bounce back. So I just wanted to do a quick overview to give you a sense of the very difficult situation we're in. We're still in the middle of the storm. So just let's jump to the US 10-year bond yield chart. I'm going to be very quick on all of these. I don't want to waste your time. We've looked at this a lot before, this being the bond yield. So remember that, US 10 years. So that's the yield going down, price going up. That's yield going up and the price of those bonds going down. Now, we were watching this 3.25% level. That was the high in 2018. There's a high around 3% in 2014. So this is a, decade high in yields that we've just shot up through on this panic. Obviously, it's been a really big sell-off in those bonds. And we are actually seeing a little bit of a reversal. So bond yields on those 10 years down to 3%. Looking like a potential false break of the high of that from 2018. So there's a bit of a line in the sand here where, possibly bonds aren't a bad buy around here, but tell you what, you'd be running away from them if yields turned around and spiked up through that 3.5% level, which was the highest level they got to recently. So, from here, I'm sort of looking up close at these on a weekly basis, and you can see that after the spike through that 3.25% level, we've got a weekly sell pivot on the yields. And bonds are starting to rally, the yield is starting to fall. So there is a chance that we could actually see a bit more of a move to the downside in those 10-year bond yields. And that may just take a bit of pressure off the extreme selling that we've seen in the tech stocks, especially, and across the board. So it may be a room for stocks to just take a bit of a breather for a while if those bonds do continue to rally. So that's one thing that I guess is working in the market's favour just at the moment. But for our market, I just want to take you through quickly what is going on in commodity land. This is the copper chart, and I'm looking at a long-term chart of copper here going back many years. And you can see the way copper moves, like most markets move, is these false breaks of major highs. So you can see here, back in 2008, 2009, prices busting up there through to a new high. Then once the false break happens, that's the beginning of the next leg down. Again in 2011, 2012, breakout to new highs, gets everyone bullish, makes people who are short get out of positions, and then it can't carry on. The false break happens, and that was the beginning of a massive leg down. And here we are here. It's taken a while. It's been creating a bit of a range. We've had one attempted rally through, and now another one that just happened recently, and the false break. It's failed. So this is looking, fairly dodgy for copper for the moment. If we're just looking at the wave higher since the 2020 low, you're nearly already hitting that point of control. There may be a bit of support around there. But if you look in the past, this false break could lead to quite a big sell-off. So with economies rolling over, recession now the big thing on everyone's minds, copper, it used to be called Dr. Copper because it's great at diagnosing the health of the economy. And it's looking like it is going to fall further. Who knows if it's going to head all the way back to the buy zone there. But, longer term, it might. It just might. So big picture, copper not looking that great, but I think the fundamentals for copper are fantastic long term. So I think in this wave down, you do ultimately want to be picking up some of those copper projects and copper stocks with a 5-year view. So looking at nickel as well, that's definitely come off the boil after that crazy spike that we saw in the futures markets. But you can see there, nickel really coming off the boil. Also zinc, after these big strong rallies over 2020 and 2021, the heat really coming out of zinc. Lead as well, that's had a good run over the last couple of years. The momentum has certainly shifted down. This is aluminium, fantastic run, and really starting to turn down hard now that economies are starting to slow down rapidly. So that tells you why so many of our commodity stocks are really coming off, and why, the Australian share market, which has been holding in there for a year. I've said the banks started to roll over. Last time I was speaking to you saying, look, it's the pillars that were holding up our market were being taken out. And that means we're probably going to do a bit of catch up to the downside. And just looking at a few other commodities out there, we've got iron ore, which has been holding up in so well. We had that massive rally to over $200, and you can see pulled back into the buy zone there, and we saw the bounce out of there back to the point of control, and is now turning down again. So it's looking pretty sketchy, iron ore. You'd want it to find the support, but now that it's already had one go at that buy zone, hit the point of control and is turning down again, my fear is that it is actually going to have a bit of a sell-off down under $100. So iron ore, not looking too good. So that means, the Rios of the world and BHP probably going to be on the nose for a while. Really, it's a tough old market out there. If I just take you through, I've shown you these charts before, this being the bank index in the S&P. I was showing that to you when it was just starting to sell off, and that's continuing to trend to the downside. And the housing over in the US is really starting to look pretty bad. This is the home builders index. You can see that selling off really hard. This is the high yield bonds. Again, I was showing you that quite a while ago, saying they look like they're rolling over from the top of this channel that they've been in for the past decade. And yeah, that is now getting towards, crisis levels in those high yield bonds. The junk bonds, another one showing you there, getting down towards where it was at the bottom of the crash in 2020. This is mortgage-backed securities, an ETF. Check that out for a bit of panic about US property. That's the peaks in 2014 up to 2020. There's the lows over the past decade, and this is what's going on at the moment. So, beneath the surface, there's some pretty serious crashes going on, which may lead to problems for companies down the track. This being the corporate investment grade bonds. And you can see the heat has really come out of those. That's what we're witnessing right now, a very serious deleveraging and selling at whatever price you can, as these yield spreads blow out from, very low levels where you had the US 10-year bonds at incredibly low levels. And then you had corporate debt. Because everyone was searching for yield, people were buying these corporate bonds, and whatever yield they could get, people were happy to pay for it. So the spread between US 10-year bonds and those corporate bonds came right in to very, very low levels because there was no yield around and everyone was just chasing yield. So now, as recession starts to hit and people start to think which companies could possibly end up not being able to pay back their debt, are you willing to buy those corporate bonds at very low rates? No. So we're seeing this. Not only are the yields on the 10-year bonds going up, but we're seeing the spreads blow out between the corporate bonds and the 10 years. So and there's all the emerging market debt problems. With the US dollar flying through the roof, a lot of offshore debt priced in US dollars. So interest rates going up, US dollar going up. When they go to refinance, what are they going to be paying? Can they pay it back? When you have these huge moves in the market, often quite big things can end up breaking at some point, and the news sort of comes out after you've seen these big market moves, and all of a sudden some news will come out and there'll be another crisis in some area because there's been these huge shifts across the board. You've got Japan with their holding their 10-year bond yield at 0.25 of 1%, which is madness, just printing as much money as they need as their currency collapses. Does their currency collapse to a point where it's a crisis? There's just so many things going on out there, which is why I'm sort of have battened down the hatches. And I'll just finish up with the stocks just quickly. And the main thing I want to point out here is this is the ASX 200. It's all played out pretty much as we were talking about with the false breaks of the high. We've had this impulsive decline, which is going back towards, major support. Because remember, I was showing you this linear regression of the whole rally over the past few decades. And you can see it's heading towards the bottom of that channel, which is where you're starting to think about value starting to appear. But there's no signs that this is over yet. And now that we've had this big down month last month, often you get a rally back into the guts of that candle before meeting selling pressure again. And if it then goes down through those lows, you're looking at, a really big sell-off possibly occurring. But we're just at the stage where we've had a big smashing. Everyone's wondering what's going on. There'll probably be some people trying to pick up bargains. Maybe the news turns a bit, inflation starts to soften off, people start buying. But that's not necessarily the end of the whole move to the downside. So for me, I don't want to make any big statements about which way it's going to go each day. I've already told you that I thought the markets were going to sell off sharply, and really they have. It's now all about, on this weekly chart, the story is, are we going to turn down straight away and break below the low of the whole correction? In which case, it really can, as I said, the rubber band snapping completely. Or is it going to be able to muddle along for a while and we see a bit of a mean reversion up to that selling pressure, but then, I'd be taking some money off the table there. I think you probably see a lot of selling pressure up there, and we ultimately will see that next leg down. But as far as predicting right now, it's all going to collapse. That's really not what I want to do. I was telling you quite a while ago when it was time to be taking profits and waiting. Now is a time when it's really difficult to decide which one it's going to do, the short squeeze or the complete collapse. No interest in trying to pick that. All right. Well, I think that's enough for the week. Hopefully you're sort of prepared for this. We're still in the eye of the storm. Don't be getting too cheeky with it and thinking that it's all over yet. Hopefully you can survive. And once the dust settles, there'll be plenty of bargains on offer. But right now, it's pretty tough going. All right, cheers. I'll come back with more next week.